This is the second part of the video series on lease accounting brought to you by Eagle Finance Tutorials. In this part, we shall consider few important aspects that we have got to bear in mind while doing lease accounting. Assets in scope for accounting standard 19. We know lease is a subject of agreement between parties. As such, two parties can agree to lease out any asset. Whenever an asset is leased out, the transaction needs to be analyzed, recognized, accounted for, and reported in accordance with Lease Accounting Standard AS 19. However, does AS 19 cover all types of assets? The answer is no. It does not cover few assets. Whenever such assets are leased out, AS 19 does not come into play. Which are those that are not in scope for AS 19? We will see them here. Number 1. Land. Agreements to use land are not covered by AS 19. Number 2. Natural resources. Agreements for exploration and use of natural resources are not covered by Accounting Standard 19. Examples: oil, gas, timber, metals, and other mineral rights. Number 3. Intangible assets. These are not in scope for Accounting Standard 19. Examples: motion picture rights, video recordings, and so on. We have a different accounting standard, AS 26, intangible assets, to take care of this. We know an asset can have a value even after it has reached the end of its useful life. It is called the residual value of the asset. Let's think of an asset having a useful life of 5 years. Let's say after the asset has reached the end of its useful life, it is still worth rupees 5,000. It is called the residual value of the asset at the end of its useful life. Suppose the asset is given on a lease for 3 years. Let's say the asset is estimated to have a value of rupees 15,000 by the time the lease ends. That is the estimated residual value of the leased asset to the lessor at the end of the lease term. How do you think the lessor realizes the residual value from the leased asset? Let's say the lessee returns the asset back to the lessor at the end of the lease term. Then the lessor disposes of the asset, that is, sells it off, and realizes rupees 15,000 or even more for his residual value. If the lessee had not been handling the asset properly, then when he brings it back to the lessor, it may not be in a good condition so as to fetch the estimated residual value. In this case, rupees 15,000. In order to cover his loss, the lessor takes a guarantee from the lessee for the amount of residual value. It is called the residual value of the leased asset guaranteed by the lessee. Because he has given a guarantee, the lessee uses the asset properly and takes good care of it such that when it is returned, the lessor is able to sell it for at least the amount that is guaranteed by the lessee. If still the asset does not sell for the amount guaranteed by the lessee, that is, if it still does not worth the amount of residual value guaranteed by the lessee, then the lessee pays the amount of shortfall to the lessor. Such guarantee for residual value by the lessee is also sometimes given by someone on behalf of the lessee, say a friend or a relative. Imagine this block represents the residual value of the leased asset at the end of the lease. It is guaranteed by the lessee or by someone on behalf of the lessee. What if the lessee is not agreeing to the amount of residual value estimated by the lessor, or for some reasons is not willing to give the guarantee? Then the lessor takes the guarantee from a third party. The third party must be independent of the lessor and financially capable of discharging the guarantee obligation. So far, we have been discussing the residual value of a leased asset on the assumption that the lessee returns the leased asset back to the lessor at the end of the lease term. What will happen if the lessee retains the asset himself? How will the lessor realize the residual value? Simple. The lessor receives the payment towards the guaranteed residual value from the lessee or someone on behalf of him, whomever has given the guarantee. Here is a chart that lays down how the lessor realizes the residual value of the leased asset. From this, we understand the lessor always receives the amount of guaranteed residual value, irrespective of whether the asset is retained by the lessee or returned back. Let's say the residual value of a leased asset that is estimated by the lessor is rupees 8,000. Part of it, say rupees 5,000, is only guaranteed. It is guaranteed either by the lessee's group, that is by the lessee or someone on his behalf, or a third party. The remaining amount of the residual value, rupees 3,000, is unguaranteed. As the name suggests, the unguaranteed residual value is normally not realizable by the lessor. However, in some cases, it might be realized also. You wonder how? Suppose the lessee brings the asset back to the lessor as the lease term ends, and the asset is in an excellent condition. Thereby, the lessor is able to sell it for the whole of the residual value estimated by him. That is, he realizes rupees 8,000 in total, which makes up for the GRV 5,000 and also the UGRV rupees 3,000. Thus, in this case, the lessor is able to realize the UGRV also. To sum up, the UGRV, unguaranteed residual value, may or may not be realized by the lessor. We shall now summarize our learnings here. We know about the payments that happen in a lease arrangement called minimum lease payments. Let's make a quick list of them. Payments during the lease term. This includes the periodic lease rentals and also any initial payment that may be required at the start of the lease. Next, bargain purchase price. We know a lease agreement may give an option to the lessee to buy the asset for himself at the end of the lease. The lessee can so buy the asset by paying a concessional price called bargain purchase price. If the lessee chooses the option, then he will pay the bargain price to the lessor. Next, the amount of residual value that is guaranteed by the lessee's group, that is, by the lessee or by someone on behalf of him. Finally, the amount of residual value that is guaranteed by a third party. These are the payments that are most likely in a lease arrangement. Apart from this, there are few other payments that may not exist in all the lease arrangements. They are as follows. Contingent rent. These are lease rentals over and above the fixed rentals payable as a percentage of revenue derived or output generated by the lessee by using the leased asset. Next, payments made by the lessee by way of reimbursing the lessor for lease expenses paid by lessor. And the last is residual value unguaranteed. As said, these payments may not exist in all the lease arrangements, and therefore these do not form part of standard lease payments. We will ignore them for now. The standard payments that normally exist in any lease arrangement are together called minimum lease payments. But then, the amount of minimum lease payments, MLPs, are not the same for the lessor and the lessee. In other words, in any lease arrangement, MLPs from the perspective of lessor is different from the perspective of lessee. How could that be? We will see it now. We know there are two parties in a lease, the lessor and the lessee. Let's see how each of these payments concern them. Payments during the lease term. These are paid by the lessee to the lessor. Thus, these are relevant for both of them. Bargain purchase price. This is also paid by the lessee to the lessor. This is also relevant for both of them. Residual value guaranteed by or on behalf of lessee. This is also paid by the lessee's group and received by the lessor, thus relevant for both the parties. Residual value guaranteed by a third party. Watch out, this is not paid by the lessee, it is paid by a third party to the lessor. Thus, this is relevant for the lessor, not for the lessee. Please note, the residual value guaranteed by the lessee's group and by a third party can't coexist. Either the guarantee is given by the lessee's group, if not, the lessor takes the guarantee from a third party. Say in a given lease, the guarantee is given by the lessee's group. Then the third party guarantee will not be there. Now, see, all the payments are relevant for both the parties. In this case, minimum lease payments for the lessor and the lessee are the same. Suppose the guarantee for residual value is not given by the lessee's group and a third party gives such guarantee. Now see for yourself the components of minimum lease payments for the lessor and the lessee are different. All of these are said to be minimum lease payments for the lessor, while for the lessee, the minimum lease payments do not include the guarantee for residual value because the guarantee is not from the lessee. From this we summarize minimum lease payments as follows. This term called minimum lease payments is introduced by the accounting standard. But why are we learning this term? What is its significance? The answer is as follows. Minimum lease payments represents the total lease payables for the lessee. At the start of the lease, the lessee discounts the total minimum lease payments from his standpoint and records the discounted value, that is present value of MLPs, as lease payables. Likewise, for the lessor, his total receivables in a lease is minimum lease payment from his standpoint plus the amount of unguaranteed residual value. At the start of the lease, the lessor discounts this and records the present value as lease receivables. We kept discussing a finance lease is a financing arrangement. The lessor provides financial assistance to the lessee for the latter to have the asset. As such, the lessor would normally levy finance charges, interest on the finance provided. What rate the lessor charges interest at is the subject of discussion here. We know any business accepts a project only if it results in a profit at a rate that is not less than its minimum required rate of return. Such minimum required rate of return is technically called the internal rate of return IRR of the business. With this said, we understand a lessor also agrees for a lease arrangement only if it yields a return at a rate that is at least equal to its IRR. It means a lessor charges interest on a lease at his IRR. When a lessor so uses his IRR in a lease arrangement to calculate his interest income, the IRR becomes the interest rate implicit in the lease. In other words, the interest rate implicit in the lease is the same as the lessor's IRR. We know when the lessor charges interest, it's an income to him. In parallel, the lessee also should account for in his books as interest expense. At what rate does the lessee account for the interest expense? Here, the deciding factor is whether or not the lessee knows the interest rate implicit in the lease. Let's say he is aware of the interest rate implicit in the lease. How does the lessee come to know? Either the lease agreement specifies the rate of interest for the lease, or the lessee is able to calculate it himself using the lease receivables for the lessor and the fair value of the leased asset. In an exam problem, if the question specifies the rate of interest of the lessor, then that's the rate that is to be applied for accounting in the books of lessee as well. In such case, the lessee uses the same rate as used by the lessor in calculating and accounting for interest expense in his books. The other situation is the lessee is unaware of the lessor's rate of interest. In this case, the lessee uses his own borrowing rate of interest. That's the rate at which he would be able to borrow additional funds in the normal course. The rationale for this rate is, suppose instead of going in for the lease, the lessee borrows a loan to buy the asset, what rate of interest he would incur? That is his incremental borrowing rate, and the lessee applies this rate in accounting for his interest expense on the lease. We have by now learned the basics of a lease, classification of a lease into finance and operating, and the key aspects that are to be kept in mind. In the next part video, we will start to learn on doing the accounting for leases.